Hello, I'm John Butler, Investment Director at Southbank Investment Research, and I'm joined today by my friend and prominent financial markets commentator, Brent Johnson. Brent is a prominent voice when it comes to international monetary affairs, including his controversial view that the United States dollar is going to remain a strong currency versus nearly, if not all others, even though the U.S. has a huge and well-known excessive debt, deficit problem, and as a result of fighting the war, funding, I should say, the war in Ukraine, also has huge obligations around the world that do not appear to be able to be reduced anytime soon. Many people see this as dollar negative. Many people regard the weaponization of the dollar, as it were, through sanctions against Russia and other countries as dollar negative. Brent disagrees, and he's going to let us know why today. Welcome, Brent.
Thanks for having me, John. I always enjoy talking to you.
Well, great to have you here. And as you sometimes say, you and I have had our feet in both the mainstream financial world and the alternative asset / gold and precious metals world for many years. And how that world has changed, hasn't it?
Yeah, it's really pretty incredible. I think we first met close to 10 years ago now. You had written a book about gold, which was kind of that. It helped me tremendously to understand that side of the world, or that specific market. I had already been involved in precious metals and had invested in it, but the way you laid out the book was very helpful to me. And when I reached out to you to see if we could meet, you were very kind, and we kind of got to be friends through that process. And one of the reasons I like talking to you is because, you didn't necessarily come from the gold world. You kind of found the gold world, but you had a foot in both traditional finance and precious metals. And that's always been helpful to me because I've had a foot in both worlds as well. And I've often found that people can talk about one or the other, but not both. And so you're one of the handful of people I can talk to, and we can kind of go down the rabbit hole on both sides of the fence, so to speak.
Well, and what a rabbit hole it is. In fact, you might even say it's a rabbit warren at this point. That is, there is so much that appears to be changing and shifting in the international monetary system. And most recently, of course, we have had the United States, together with its NATO allies, pushing for a general confiscation of Russian assets held abroad. Not just a freezing of assets, but an outright confiscation. And there's been some discussion as to whether something like that would be dollar positive or dollar negative in its effects. What are your thoughts on that?
Well, probably not surprisingly, it's a little bit nuanced, right? I think a lot of people want to jump in the black or white camp right away. I think that in the years ahead, when we look back, that will be seen as a seminal moment in the global monetary system. That will be, a very strong road marker of where perhaps things either started to go wrong or really started to go wrong. And I don't think that they should have done it. I'm not in favor of that policy, but I'm not surprised by that policy. I would expect them to continue to do things like that. And while I think in the long term that is bad for the dollar and the global reserve currency, I think the chaos that it potentially causes in the short to medium term actually causes the dollar to get stronger, not weaker. Now, nothing goes in a straight line, and perhaps the dollar, goes down for the next 6 months. But I don't think we can transition from our current global monetary system to another global monetary system without the dollar going higher in the process. Now, if I end up being wrong on that, I'm happy to raise my hand and say, you know what, I got that wrong. But as of right now, things seem to be playing out, at least for the most part, in the way I foresee it happening. Despite all of the crazy policy that we've had either over the last 4 years or the last 50 years, certainly since the global financial crisis, whether runaway deficits, trade deficits, wars, QE, helicopter money. And yet, a couple of years ago, the dollar went to its 30-year high versus its peer currencies. It's still stronger than it was during the COVID crisis. And so while the dollar may lose purchasing power, as all fiat does, the dollar actually, compared to many of its peer fiat currencies, has many advantages that the rest of the world just doesn't have. And I've said many times that I think in some ways these advantages are perhaps undeserved, but they're there. And as an analyst, I have to my best ability, step back, remove my emotion and my own preferences, and figure out what I think is going to happen. And I think the dollar is going to get stronger.
Well, it's certainly, though, it would seem counterintuitive. As you say, the very factors, the very changes that would need to happen in the event that the international monetary system would reduce its reliance on the dollar, you're saying those changes counterintuitively would in fact be dollar positive up to a point. I fully understand that once you get beyond the event horizon, all bets are off. But that there's this natural upward squeeze on the dollar when you get into general international credit crisis conditions. Could you elaborate on that a little bit for our viewers?
Sure. And listen, I don't know that other people made this mistake, but I made this mistake. So I'll tell you the mistake that I made, and then perhaps that will help explain my point of view. For a long time, many years, in fact, I would analyze the dollar by analyzing the United States. And when you analyze the United States in a vacuum, the only possible conclusion you can come to is that it's in a really bad place and bad things are going to happen, and there's no way that this can possibly last. And so anybody that does that and comes to that conclusion, I don't disagree with them. The problem is that we live in a big world. It's not just the United States. The United States may be the dominant country, but it's not the only country. And the dollar may be the dominant currency, but it's not the only currency. And if you start to do the same level of analysis on other countries that you do on the United States, you find out that they have significant problems as well. And then when you realize that, all the other countries use the same system, the United States, they all have fiat currencies to some extent or another, and they all trade relative to each other. You can, if you were a basketball coach and you you were a seventh grade basketball and you walked into the gym and you had 10 players there, and, two of them can't tie their shoes, three of them, are 2 feet tall, and you'd say, God, these guys are horrible. But one of them is going to be your best player, right? No matter how bad he is, one of them is going to be the best player on the team. And so once I started realizing that and started thinking in relative terms, that changed the thing. But the thing that really changed for me was when I realized I had been ignoring the euro-dollar market. And many people don't even know what the euro-dollar market is. And many people who have heard of the euro-dollar market automatically think that means euros, right? Americans, for the most part, are not the most financially literate because they haven't had to be. They've only grown up with one currency. You talk to anybody else that grew up in any country other than the United States, and they think in 2 currencies. They think in their local currency, and they think in the U.S. dollar terms. And they know exactly what the exchange rate is. You go anywhere in the world and you ask what the U.S. dollar exchange rate is, 99% of the time, they're going to be able to tell you. And so what the euro-dollar market is that dollar balances and dollar extended credit outside the United States, oftentimes, in fact, most times, that don't even include an American entity. So it's a French bank making a loan to a Turkish corporate, or it's a Japan corporate or a bank extending dollar-based credit to a supplier. And this market has grown tremendously large. The euro-dollar market, the last time they tried to measure it, which was like 25, 30 years ago, it was 2 or 3 times the size of the U.S. dollar market at that time. And without going into too much detail, John, you'll understand this, but perhaps maybe some people don't, is that for our system to continue to exist, it has to grow. If it doesn't grow because of fractional reserve banking, then you get a credit crisis, you get a collapse. And so if 20 or 30 years ago, it was 2 or 3 times the size of the United States dollar market, for them both to still exist, they both must have grown. And so the point I'm making is that this euro dollar market, it's estimated, and it's very opaque and it's hard to measure, but the Bank of International Settlements estimates that there's $30 trillion of dollar-based debt outside the United States owed by non-U.S. entities. That's just the bank debt. Then if you start looking at off-balance sheet debt and derivatives that it's like 60, 70, 80 trillion. Now that's a tremendous amount of money that the rest of the world has to pay, has to service, has to pay off, and so once you realize that is demand for dollars. And so I think a lot of people are familiar that the United States owes 30 trillion or 35 trillion, whatever the number is today. It seems to go up at an increasingly rapid pace. But the rest of the world owes that money as well. And so once you realize there's that amount of excess or external demand for the currency, that is part of the reason why the U.S. has been able to, quote unquote, get away with these, profligate fiscal policies for so long, because there's a drain that takes the money that's printed, or however you want to describe that, out of the U.S. and it goes internationally, and there's demand for it. If any other country ran similar policies, that currency would stay within their borders because, Turkish lira are not needed in South Africa, or Australian dollars are not needed in Russia, or whatever it is. But all of those countries use dollars to some extent. So if any other country tried to do what the U.S. was doing, that currency would stay local, and you would get high rates of inflation. You would get, a high loss of purchasing power. You would get corporate credit events. And it would just, the profligate policies would show up quicker in other currencies that don't have that same external demand. And when I figured that out, that's kind of what changed things for me as far as the dollar. And again, I want to be clear on something. When I say the dollar is going to get stronger, I mean it's going to be a strong currency. It doesn't necessarily mean it's going to hold its purchasing power in real terms. But when I compare the dollar to other currencies, other fiat currencies, then I think it will be, the best of the bad bunch, so to speak.
Okay. And you hold on to that, notwithstanding the fact that there are some countries that are very large net exporters, that have very large accumulated foreign exchange reserves, that don't run chronic deficits, that have generally sound finances, very low, if any, external debt. You think that due to the structure of the international monetary system, including, importantly, this enormous euro-dollar market, you believe nevertheless that these, well, on paper at least, cleaner, dirty shirts, countries that have generally sound finances, nevertheless are not going to see their currency strengthen versus the dollar longer term. So, I mean, for example, you could put the Swiss franc into that mix, say, or you could put the Norwegian krone into that mix. So, are you allowing for exceptions here, or do you think?
Fair. Well,
okay.
So in general, countries like Switzerland, which has, again, Switzerland is a little bit unique because it's a small country. It's not nearly as large as the outstanding amount of U.S. dollars, but it has a lot of external demand for its currency because people want to put their money into Switzerland. Wealthy individuals, institutions all around the world want to put their money into Switzerland. And if you're going to put your money in Switzerland, you need a Swiss franc to do it. And so there's a huge external demand for the Swiss franc in the same way that there's huge external demand for the U.S. dollar. Now, Norway is a little bit different because they have huge natural resources, and oil is, the lifeblood of the entire global economy. So there are some exceptions. And in the short term, perhaps those currencies can kind of hold up or hold their own versus the U.S. dollar. There's a lot of countries that are not like that and don't have nearly those same advantages. And I think that those are the countries where it starts first. But ultimately, if you get into a situation where these other countries that don't have all those advantages start to have currency crisis, or they start to default on their U.S. dollar debt or their euro dollar debt, that's when you get a credit contraction. And so far, the governments around the world, let's go back to the global financial crisis through COVID, for the most part have been able to cooperate and work together. And whenever these crises have popped up, they've been able to, push it back either through monetary policy or government regulation or bailouts or whatever it is. They've been able to contain crises. What I think is a little different now, especially post-COVID, is the world is no longer getting along the way it used to. We're no longer cooperating the way we used to. We're no longer globalizing the way we used to. In fact, I would characterize it as a global divorce that we're going through. And sometimes divorces are smooth and easy, and sometimes they're very difficult. And I think this will be a very difficult one. And there's always two sides to every story. But I don't, if we have another crisis, which I think we will, typically we do, and I don't think the world will be able to cooperate, or I don't think they will be willing to cooperate to the same extent that they did before. And the way they have typically responded is to provide a lot of global liquidity. Now, not only have they done that before, and not only do I not think that they will cooperate as well as they have in the past, I do not anticipate the United States, quote unquote, helping out as much as they have in the past. And in fact, I think they may purposefully withhold dollar liquidity to certain entities in order to punish them economically. And I think that's part of the reason the dollar has gotten strong over the last couple of years. I think they have purposefully weaponized it. And I would expect them to continue doing that. Now, do I like that? No, not really. But that doesn't mean I expect them to act any differently. To your point that the concept that we started off with of the confiscation of, foreign currency reserves of a foreign country. In the long arc of history, I think that will be seen as a mistake. But in the short term, since they did that, the dollar has gotten stronger, And so it is because of all this leverage in the system. If you're going to deleverage a system, that means you need to earn more than you spend and you need to pay down debt. I have never seen a government willingly do that. Now, maybe they will change their mind and start doing that. But again, the numbers are so big. I don't think that they have the ability to do it, especially in a fracturing world, in a world where there's no longer cooperation. And when an entity delevers, that means debts are being paid off. And when that happens, supply contracts. Again, this starts to get a little technical on how the global monetary system is designed. But as you get a contraction of credit, or as you get a contraction of supply, but you still have demand, that can push a price higher. And the other thing is, if we were to get in one of these credit crises that isn't contained as quickly, then you get in a situation where supply is quickly contracting. And in that case, that's when you can get a dollar spike. So I don't think, and then finally, and I know I'm kind of rambling here, but then finally, I think this system benefits the United States. I think it would be hard to argue that it does not benefit the United States. Now, there are some people who have said that it no longer benefits us the way it used to. It's become too expensive. It would be better if we didn't have the global reserve currency. But I think that's looking at it from a purely economic perspective, and it's not looking at it from a power perspective or a geopolitical perspective. And I think the U.S. likes being the global hegemon, and I don't think that they would willingly give it away. And so if we ever got to a place where de-dollarization or de-USization, however you want to call that, the getting away from U.S. hegemony, if that was ever seriously threatened, not just talked about, but seriously threatened, I would expect the U.S. to take another step to protect that system. And whether that's, increased sanctions, increased monetary weaponization of the dollar, or military action, I would expect them to do that. And so my basic premise is that we cannot move from the current system to a new system without a period of either economic volatility, high economic volatility, or military violence. And under either of those two scenarios, I think at least during that period of time, the dollar goes higher. Now, once you get on the other side of it, then I think all bets are off. But that's kind of my thought process on the dollar versus other currencies.
Well, look, I don't think anyone would disagree with you that the U.S. enjoys being a global monetary hegemon. However, the exorbitant privilege that the United States arguably still has and has had for many decades has been called into question through the decades by some very prominent people who pointed out that, okay, fine, right, this might be in the U.S. interest to have this system, but is it necessarily in our national interest? Of course, Charles de Gaulle is famously goes on the offensive in this regard in 1965 and starts working with his allies to try and see if there could be some modification made to the dollar-centric Bretton Woods system back then. It was his finance minister, incidentally, Gerard d'Estaing, who coined that term exorbitant privilege. But it seems to me, in recent years, we've had a series of fresh abuses of the exorbitant privilege. We're not just talking about running excessive deficits and accumulating a huge external debt. We're not just talking about zero or negative interest rates to re-liquefy and bail out the U.S. financial system. Now we're talking about sanctions, not only on a couple of countries around the world that, to be fair, probably have issues with many, if not all, other countries, but some of the biggest countries in the world. And indeed, it's rumored that when Anthony Blinken, Secretary of State Blinken, went to China a couple weeks back, he very specifically threatened to start putting the sorts of sanctions on China that the United States has already put on Russia as a result of the Ukraine war. And I mean, China's economy, it depends on how you measure it. Are you measuring it at purchasing power parity or not? But certainly China's economy is the same order of magnitude as the U.S. economy. So this sanctions game, which is arguably a dangerous game of chicken, if you ask me, is becoming a really big global game now, not just a little sideshow where the U.S. occasionally punishes some small country for not doing its bidding in some matter. So we're getting into a situation now where big countries have very clear and present incentives to reduce or possibly even eliminate use of the dollar in bilateral trade. Now, as you've made clear, that's easier said than done. But if you're in a war situation, you start to look at your limited set of options and your difficult set of choices. And history demonstrates that sometimes that results in risky, perhaps outright reckless and dangerous behavior. And I wouldn't be at all surprised to learn that Russia, China, and possibly some of their other key trading partners are deep in discussions about how to wean themselves away from this dollar-centric monetary system, notwithstanding these euro-dollar issues that you've detailed. Any thoughts on that?
No, so I think you've touched on a very good point. And this is probably a good opportunity for me to explain this in a little bit more detail. Because I do think I'm somewhat misunderstood on this particular point. I do agree with everything you just said. And nobody likes to be told what to do, especially the president of a country, right? So nobody likes to do what the United States does. And so there's no question there is a desire to get away from the U.S. dollar system by many foreign leaders. There's no question in my mind that they will continue to try to do these types of things that you're suggesting. And in fact, they may be even forced to do this type of thing. Necessity is the mother of all invention, right? Whether it's because of economic conflict or military conflict. It's the process of doing this that I think pushes the dollar higher. So everything you just said, I think that's very possible. But here's what I would want people to think about. If China and Russia and Iran and a couple other, a handful of global South or BRICS countries were to take concrete steps to de-dollarize, all of that global euro-dollar debt that has already been taken out still exists. And so not only do you have to get those, 5, 6, 10 countries, whatever, to agree on what you're going to do going forward, you have to get them to agree to suffer the pain of no longer servicing those U.S. dollar liabilities. And because this euro-dollar debt, these liabilities exist outside the United States, in our system, the way it's currently designed, one person's debt is another, or one entity's debt is another entity's asset. And so if they decide to no longer service those assets or those liabilities, and somebody's asset is decreasing in value. And again, they're not defaulting on the United States, they're defaulting on each other because the entity that lent that money is outside the United States. And so if these countries get together and actually start putting concrete steps to de-dollarize, a couple of things happen. One is I think that probably starts the potential credit event that I was talking about. And if they no longer trade in dollars, that means less dollars are circulating. So now there's even less supply of dollars to circulate to service this already large, pool of dollar liability. So I think in many ways, the process of de-dollarization, whether done out of necessity or done out of desire, actually pushes the dollar higher versus other fiat currencies in the process. Now, it's possible that copper and gold and nickel and cobalt and, wheat and corn and all these commodities rise as a result as well. So it's not that the dollar rises and every asset falls, but I think in that process, the dollar rises versus fiat currencies. And I think for those countries that are now trying to de-dollarize, they would have to accept the pain of their U.S. dollar assets also disappearing. So in other words, you can't just get rid of your U.S. dollar liabilities without also getting rid of your U.S. Assets. So one way I would characterize this is, let's pretend that I decide that life would be better for me if I moved to Brazil. And so, and Brazil put a new system in place, and they've got better leadership, and they have all these incentives, and they're no longer going to have this oppressive dictator next door that's telling them what to do. And so, I say, that new system, I like that new system. I'm going to move to Brazil. But I'm going to leave all of my assets here, and I'm going to burn my dollars, and I'm just going to abandon them, and I'm going to move to Brazil and start all over. I don't think many people would do that. I think many people would want to, I'm going to convert those dollars to reals, or I'm not just going to give those assets away, right? I'm not going to completely start over. But I think if the rest of the world were to de-dollarize and just walk away from those U.S. dollar liabilities that they owe to each other, in many ways they are saying we are just going to leave those U.S. dollar assets aside. We are not going to convert them to something else. We're going to let them burn. We're going to let them disappear, and we're going to completely start all over. Now, I can't completely rule that out, but I think that's a fairly low probability. That would create a lot of volatility in the process.
Well, of course it would, but now let me just stretch your analogy a little bit further. Let's say that you are being threatened with imprisonment for a crime that you don't even think is really a crime, and the government's saying, well, look, this is it. You either have to leave the country or we're going to throw you in jail. Now you have a situation that is perhaps more akin to the situation that Russia finds itself in today and China might find itself in tomorrow. If your global assets are going to be frozen or confiscated anyway, then why do you still want to play within that system as your best choice when you have this admittedly disruptive alternative? But the nice thing about the disruptive alternative is you have an opportunity to strike an extremely powerful financial blow against the ability of the nation you see as the aggressor to be able to continue financing their aggression. So fine, you suffer disruption, but you blow up your enemy in the process as opposed to simply experiencing disruption. One of those choices might be deemed more attractive. And again, this is where history suggests that when you get into war situations, the types of calculations that take place are very, very different than when you are operating in a more peaceful environment. So I wouldn't suggest for a moment that trying to move away from the dollar wouldn't be disruptive. And indeed, it might be disruptive more or less exactly along the lines you described. But if the alternative is to not have a response to what is seen as aggression and just going along with it indefinitely, I think Russia might have crossed the Rubicon on that one. And that's why I interpreted this recent announcement by the government, the Russian government and the central bank, basically to start tightening the screws on Russian private companies' ability to do business in dollars at all. That is to simply start having a zero tolerance policy that is, look, if you want to do business with a Russian entity, private or state, you're going to have to start doing business in rubles. They've kind of given China and other countries fair warning that they're not going to play this game anymore. Now, you might respond, well, China won't agree to that. Well, Anthony Blinken was just threatening China with a lot of sanctions. Maybe they will start to consider a proposal like that would reduce or give them a possible way out if the U.S. gets much more aggressive with threatening sanctions on China. So anyway, I was bringing it back to you there.
I think you're right there. Again, I don't disagree with your characterization. I think that's exactly what's happening. But I think that would lead to the dollar. I think what you're describing ultimately leads to the dollar weakening. But in the short to medium term, I think what you're talking about causes volatility and causes chaos and perhaps leads to military intervention. And I think those steps cause the dollar to go higher. First of all, I don't think you and I are saying completely different things.
No,
I think perhaps it's a question of timing of what happens. And so I think what you're describing is how we would eventually get away from a U.S. dollar-centric system. So I'm completely on board with you there. But I think the process that you're describing, at least in the short term, causes the dollar to go higher rather than lower. And I think perhaps that is where I am most if I am misunderstood, I think that may be where I am most misunderstood. Right. I don't think it's possible to do what you're describing without the dollar going higher in the process in the short term.
Okay. Well, again, I think it depends on which currencies you're talking about, right? If you're talking about the euro, which has its own internal issues, which have never been resolved and are only becoming worse through time. That is the internal imbalances within the euro area. Then you have the UK, which has a very large external deficit, which as a share of its GDP is comparable to that of the United States now. Yeah. So the UK is also exposed, you could argue, to the sort of volatility you describe. It seems that in terms of timing, perhaps the only thing that you and I can clearly agree on, not just the fundamentals, not just where we're ultimately going with all this, but the timing, the thing we can agree on is gold. I mean, how can you talk about this? Let's face it, Brett, when we used to have these conversations a decade ago, we never envisaged that a mere 5 or 10 years down the line, we'd be reading these sorts of headlines about the biggest war in Europe, right, since World War II, about the U.S. threatening China with major economic sanctions, about all the debate and discussion about the global South getting increasingly annoyed with the way the international monetary system works, and so on and so forth. I mean, this is mainstream news. Yeah. And I think it goes a long way to helping to explain to anyone, regardless of their specific views on anything, including timing. The case for owning gold is arguably stronger today than it has been at any time since the late 1930s. I mean,
listen, no, I totally agree with you. And again, I think sometimes people, I said from the very beginning when I started talking about the dollar, I said the dollar is going to get stronger and it's going to rise versus its fiat peers. But we will get into a period where the dollar and gold are rising together versus all the other currencies, and we're kind of there now. And there'll be periods where the gold goes up and the dollar goes down, dollar goes up and gold goes down. But over the arc of history, I think that's where we're at. I think we're in that period of time now. And, for all the reasons that you just described, I think, gold will continue to get a bid. The one thing I would say also is that, and this is not me taking a shot at gold. This is me saying that part of the reason, it's done very well in U.S. dollar terms, but it has done even better in euro terms, and yen terms, and yuan terms, because the dollar is rising versus those currencies. So those currencies and gold has been rising versus the dollar. So the gold is rising even more versus those other currencies. And if I was I recommend my U.S. dollar clients own gold. But if I had and I actually do have a couple of European focused clients or based clients, I even highly recommend that they own gold, because I think in this quote unquote global divorce that we're going through, in many ways, I think Europe is being sacrificed in the process. And I think one thing that people don't realize is in many ways, the U.S. has started putting sanctions on Russia, and they've talked about putting sanctions on China. But those countries are also in favor of the divorce, right? They are putting policies in place to protect their fiefdoms or their countries or their markets. And so I don't think that they're totally upset about the divorce, right? And I think they're somewhat in favor of it too. And in many ways, Europe's just getting left out in the cold, right?
Yeah.
And I think you can look at Germany as a good example. I mean, the deindustrialization, 10 years ago when you and I first started talking about it, we weren't talking about the deindustrialization of Germany. But that's what we're seeing, right? And, Europe is largely in a depressive state. I don't know that we could say they're in a depression, but compared to the rest of the world, they're not in a good place. They've got political infighting. They've got a war on their border. The engine of their manufacturing is shipping off to the United States and China. Again, some industrialization is leaving Germany and going to China. Some of it's leaving and going to the United States. Some of it's leaving Italy or Germany and going to Switzerland or Liechtenstein. But the point is that Europe is kind of in the middle, and they're trying to figure out what to do, but they're just not in a good spot right now. And unfortunately, I think even though the UK separated from them, from the EU a couple of years ago, just by proximity, I think the UK suffers some of the effects as well, even though those are some of the U.S.'s biggest allies. And I would expect, the U.S. to help them in a crisis. It's just, again, you've got the mother and the father going at each other, and the kids are kind of the collateral damage.
Yes, well, it is, I think the divorce analogy is quite a good one. And of course, divorces are usually quite disruptive, not always, but it's just the reality, especially when children are involved. And I think that what's being fought over here is not just what to do with the children, but also, of course, what to do with the family silver, or in this case, gold. And it is interesting also, I've seen multiple reports recently that there's been an increasing number of countries seeking to actually physically repatriate their gold from the United States because they're concerned that where this is going is a situation where the U.S. literally just slams the door shut and will not even let countries repatriate gold.
That would not surprise me at all. In fact, I would expect that. I would expect that.
Well, we are definitely living in interesting times. So not only do you want to own that gold as the ultimate hedge, you don't want to have it in custody in a jurisdiction that you think might be at risk. And it does seem that many countries around the world, at least officially, are voting with their feet in that regard. And as you know as well as I do, Brent, that a lot of wealthy people who own gold prefer not to hold it inside the United States. Even Americans, even Americans prefer to hold gold in a more neutral jurisdiction. I mean, we've discussed Switzerland already. There are others. I think that's incredibly important advice, even for a typical middle class household. To the extent that you own gold, own it properly, right? Own it properly in a jurisdiction that's not at risk of God knows what mayhem lies down the road.
Right. Totally agree.
Okay, great. Well, look, I appreciate your thoughts as always. Would you like to briefly let our viewers know where they can find some more of your work if they'd like to learn more?
Sure. So, I'm pretty active on Twitter, as you know. My handle is Santiago AU Fund, but you can just look up Santiago Capital in the search engine, and it's a white seashell logo. My friend John, another friend John, and I do a weekly show on YouTube called Milkshakes, Markets, and Madness. You can check that out. We have a lot of fun with that one. And then, I do have a website. It just has my contact information on there, and that's for regulatory purposes. But if anybody has more specific questions, I'm happy to try and entertain them. My business is managing money, and I manage money for high net worth individuals, fairly high minimum, and we kind of customize portfolios to every individual. So I'm not running a mutual fund, I'm not running an ETF, I'm not running model portfolios where everybody does the exact same thing. What I really try to do is figure out what it is that person or the family is trying to accomplish, what assets do they have, what liabilities do they have, where are they trying to get to, and then really kind of come up with a customized plan to help them get there. So, I always have a very big picture view. I wouldn't say I'm not a details guy, but I focus on the big picture first and then drill down into the details. And so that's why I love talking about this stuff, because I think in many ways the macro environment is going to trump the micro details in financial markets over the next several years.
Well, certainly, if any of what we've discussed this time around comes to pass, then I think you're absolutely right. Well, look, Brent, thank you very much for joining me today. I'm sure our viewers appreciate your time. I certainly do. And I look forward to chatting with you again, perhaps a few months down the road, or perhaps in response to one of these events coming to pass, or something totally unforeseeable. I mean, my God, who knows what's going to happen going forward. So thank you very much. And
you're welcome.
Yeah, great. Thanks, Brent. So I'm once again signing off. John Butler, Investment Director for Southbank Investment Research. Thanks for watching.